Welcome to an essential guide to understanding bonds and the powerful U.S. bond market. These seemingly complex financial instruments are the bedrock of global finance. The U.S. bond market is one of the largest and most influential financial markets in the world, shaping everything from mortgage rates to business investment. So what exactly is a bond? At its simplest, a bond is a way for an entity, like a government or corporation, to borrow money from investors. Think of a bond as a formal IOU. It's a debt security, where the issuer promises to pay the investor back the principal amount at a specified date, plus interest payments along the way. The three key components are the principal, or face value, the coupon, which is the interest rate, and the maturity date, when the principal is repaid. A crucial concept to grasp is the relationship between bond price and bond yield. They move in opposite directions, a concept known as the inverse relationship. When a bond's price goes up, its yield falls. Conversely, when a bond's price drops, its yield rises. This is fundamental to understanding the bond market. Yield is essentially the return an investor gets from a bond. Because the coupon payment is fixed, the yield changes based on the bond's market price. So what are the primary forces driving bond yields up and down? There are two major catalysts you need to watch. First, expectations about inflation. Higher inflation means investors demand higher yields. Second, the Federal Reserve's monetary policy, especially interest rate changes, directly impacts bond yields. Other factors include economic growth forecasts and perceived risk. Strong growth often pushes yields higher, while increased economic uncertainty can lead to flight to safety buying, pushing yields down. Understanding why bond yields matter is key to understanding the broader economy. Their influence stretches far beyond the bond market itself. Bond yields, particularly U.S. Treasury yields, serve as the baseline or risk-free rate used to calculate interest rates for virtually all other global financial products and lending. In the world of bonds, the 10-year Treasury note holds a special status as the most closely watched benchmark. The yield on the 10-year Treasury is considered the primary benchmark because its duration represents a sweet spot for gauging long-term economic health and inflation expectations. Perhaps the most direct impact bond yields have on your life is through borrowing costs. Mortgage rates are heavily influenced by the 10-year Treasury yield. Rising yields translate directly into higher mortgage payments and higher credit card rates. Auto loans and the cost of capital for businesses are also tied to these yields. Higher bond yields mean it's more expensive for companies to borrow, affecting their expansion plans and hiring. Bond yields don't just affect debt. They have a profound influence on the stock market and the broader economic outlook. Bond yields are often seen as leading indicators of economic health. The difference between short-term and long-term yields, known as the yield curve, is especially critical for predicting recessions. For stocks, rising yields often make bonds more attractive compared to stocks, potentially pulling investment out of the stock market and lowering valuations, especially for high-growth companies. The U.S. bond market is a powerful force, influencing your mortgage, your credit card interest, and the performance of your retirement portfolio. Understanding it is crucial for navigating your financial world.